Okay, so oil has switched between gains and losses this morning. That pipeline carrying Russian oil to Hungary reported to have been restarted. We got the attack on the tanker off the coast of Oman. The Israelis are pointing the finger at the Iranians there. Let's get more on the oil market by one of our favorites, Bill O'Grady, Chief Market Strategist at Confluence Investment Management. Bill, always great to talk to you. What are you paying the most attention to in the oil market right now?
Well, a couple things. The first is December 5th. On December 5th, the EU is expected to implement its insurance sanctions on Russian crude oil. We do expect that Russian crude oil will continue to flow, but it's going to become a lot trickier to take delivery on seaborne oil. Several of the major choke points will not accept anything but European or U.S. insurers on the tankers, and if you don't have it, you're going to have to avoid those. So that's going to have effects on available supply. Second thing I'm watching very closely is diesel. Diesel spreads to gasoline have reached historic levels. Shortages are there. The market's very tight. And it's interesting enough, it's actually a bit of good news for American drivers because you get roughly about 50–60% of a barrel of crude to gasoline and about 30% to distillate. So if they're having to make diesel, they're going to make more gasoline than the market probably is going to need. So a little bit of good news on that front. But those are the two things I'm watching with great interest.
Bill, last time you were on, you said we could easily see oil sliding down to the low 60s. Remind us why you were cautious, and are you similarly wary of oil prices right now?
Well, you've just got a lot of cross currents in place right now. The global economy is weakening rapidly. The target numbers today are just indicative of the fact that a recession is coming. I get a charge out of a lot of advisors I talk to. It's like, when you tell them a recession is coming, they think it's in the next 20 minutes. But but it is coming. It would be a miracle to avoid it. Esther George from the Kansas City Fed kind of intimated that today or yesterday. So that's a depressant. On the other hand, I've been kind of impressed lately with what we're seeing out of China. The Chinese are holding to this zero COVID officially, but unofficially, you're seeing a lot of let up. I think you finally have reached the point where the Chinese citizenry just can't tolerate the lockdowns anymore. And if China starts to open up, even with a slowdown in the rest of the world, that's helpful for crude. And then, of course, the other thing to kind of eventually get to your answer, you've got so many cross currents right now that probably the best bet is volatility. Because you could easily make a case for lower prices based on slower economic growth, but there's enough supply issues out there that it would make you a pretty bold trader to get aggressively bearish here.
Because we got that report, I'm sure you saw it, Bill, this week, that oil inventories in the developed economies at their lowest in nearly 20 years.
Oh, yeah. It is. It's a very tight market. We do have some relief coming. Guyana is close to coming online, and that's going to be a pretty significant amount of new oil. And probably a year or two, we're going to be seeing 1.5 to 2 million barrels a day of new production on the market, which is really good. Bloomberg's Tracy Alloway and Joe Weisenthal, have a podcast on it. I recommend taking a listen if you like it. And that's real positive. On the downside is that it looks to me like, we're going to see declines in Russian oil production, even if sanctions are not perfect, just because there's a lack of investment. And so it's going to be a tight market.
Yeah, I guess they have been cut off from supplies and expertise, the Russians. It's such a global industry. Just walk us through the distillates again, Bill, because there's such a focus there. We've heard our neighbours in Connecticut are seeing rationing of heating oil. And heating oil and diesel, very similar. They're taxed differently. So it's a tight market, though.
Well, and that area you're referring to has its own idiosyncratic issues. There's a shipping law in the United States called the Jones Act, which requires American shippers to move any product inter-America. And so what you see for most shipping is pipelines. But the area of the Northeast doesn't have much access to them, so they usually get their diesel and heating oil by importing it. And this year they haven't been able to do so because of the demand from Europe. And so they've been caught short. And it's not that there isn't the diesel there, it's just that under current shipping rules, it's very expensive and there's really not a lot of capacity to move diesel from the Gulf Coast to the Northeast. And it doesn't look like that's going to get resolved unless the rules surrounding the shipping are relaxed.